Welcome to the deep dive. We're grabbing a stack of SENS announcements that hit the JSE today, May 26, 2025, and diving right in.
Yeah, let's do it. SENS, the stock exchange news service, it's, where all the really crucial company news drops, results, deals, changes,
Everything.
pretty much everything the market needs to know, officially.
Exactly. And our mission today is, well, to cut through that fire hose of information. We're going to pull out the most important bits, group similar updates together,
Yeah.
make it easier to digest,
Mm-hmm.
and really get to the heart of what's driving things inside these companies and, what it signals for the wider market.
Think of this as your essential briefing. We've done the sifting, kind of. We're bringing you the critical details and helping you understand why they matter
Yeah.
without getting completely lost in the fine print.
Yeah.
It's about getting informed, fast, and hopefully with a bit of insight.
You got it. We're talking everything from major financial results, some surprisingly strong, others, well, still grappling with challenges to the corporate strategy plays, changes in the boardroom, and specific updates on financial instruments. Okay, let's kick this deep dive off. So, setting the scene for today, May 26, 2025, the sheer variety of announcements is striking, isn't it? It's not just results. It's a real mix of everything.
It absolutely highlights the dynamic nature of a listed market. You see companies reporting on past performance and signaling future intentions
Right.
through deals, board appointments, or capital structure changes,
Right.
all hitting the wires basically at the same time. For anyone trying to understand what's moving the market, this is the raw data you look at.
Right, the actual pulse. And speaking of performance, let's jump into the big numbers first, the financial results. Several companies reported today, and there are some headline figures that definitely grab your attention.
Yeah, these give us probably the clearest picture of health and progress, or lack thereof sometimes.
Altron, AEL, is one that caught my eye. Full-year audited results to Feb 28, 2025. The SENS leads with headline earnings per share HEPS up over 100% for the group to 134 cents. I mean, over 100%? That sounds huge.
It does sound huge. And look, it is significant, but there's important context there. Last year, the group actually reported a negative HEPS, a loss.
Oh,
So while the percentage jump is massive, it partly reflects coming off that very low negative base. The real story is that they've moved from a loss to profitability at the group level. I think the 73% increase in HEPS for the continuing operations hitting 178 cents, that's maybe a more direct measure of the performance of the core ongoing business.
Okay, that context is really key. So 73% growth in the continuing business is still incredibly strong. What's driving that? The SENS points to the platform segment, Netstar, Altron FinTech, Altron Health Tech.
Yeah, that segment is performing exceptionally well. They reported, 12% revenue growth and 23% EBITDA growth.
Wow.
Why? Well, these are often annuity-based businesses, with recurring revenue streams. Netstar hitting over 2 million subscribers. That's up 16%.
Huge number.
That's a massive driver.
Yeah.
Clearly benefiting from vehicle tracking and telematics demand. And FinTech's 38% EBITDA jump. That's apparently fueled by strong SME growth and more payment transaction volumes. They've clearly focused on those sticky high-margin areas within their portfolio.
And they're sharing that success too, boosting their final dividend by 52% to 50 cents. That's a tangible return for shareholders, isn't it?
Absolutely. A significant dividend increase like that, it signals confidence from management and the board about current cash generation and, future prospects too. Really reinforces the message that their strategic shift is paying off and translating into shareholder value.
Now, it wasn't all smooth sailing. Group revenue was slightly down, though that's largely because they sold the ATM business, right? Excluding that, continuing operations revenue was up maybe modest 3%. The SENS also mentions IT services is still seeing some customer spending delays.
That nuance is important, yeah. While platforms is firing on all cylinders, other parts of the business, like IT services, reflect a more cautious spending environment, particularly in corporate IT. And those strategic disposals, like the ATM business sale and the planned sale of Altron Nexus, they're central to their strategy of simplifying the whole thing and focusing on those higher growth, higher margin areas.
Okay, makes sense. Moving on, Pick and Pay, PIK. The SENS describes their annual results for the 53 weeks to March 2, 2025 as much improved, even a turning point.
Is it really a turning point, though?
Look, the results are significantly better. There's no doubt about that. Reducing the loss before tax and capital items from, our $1.4 billion last year to our $237 million this year, that's a substantial improvement.
Yeah, huge difference.
That's progress you can actually measure.
And a lot of that seems tied to the massive recapitalization they did, our $12.5 billion raise, closing the year with our $4.2 billion net cash. Plus, the value unlocked by listing Boxer separately, estimated around R30 billion market cap. That's the foundation, really. The recapitalization and the Boxer listing have dramatically strengthened their balance sheet. It allowed them to pay down debt and freed up capital to reinvest in the core pick-and-pay business. And, it also highlighted just how valuable that Boxer asset is within the group.
The pick and pay segment itself also saw a big reduction in its trading loss, from R1.5 billion down to R549 million, and it even returned to a trading profit in the second half. And like-for-like sales and company-owned stores reversed the trend, growing 3.3% after declining the year before. Closing or converting 40 loss-making stores also seems like a necessary, if painful, step.
Those are critical operational metrics, absolutely. Getting the core P&P retail engine back to profitability is the ultimate goal, right? The positive movement in like-for-like sales and that return to H2 trading profit suggests that initiatives like improving store execution, pricing, supply chain, maybe they're starting to bite. And closing unprofitable stores stops the bleeding. Simple as that.
But, and this feels like a big but, the SENS also states that a material loss remains when you include lease interest. And the expected break-even for the pick-and-pay business has been pushed out again, now to FY28 from the previous FY27 guidance. Does that sort of temper the optimism around this turning point?
Oh, it absolutely does.
Yeah.
While the operational performance is clearly improving, the burden of legacy costs, particularly those lease liabilities on older, maybe underperforming stores, is still significant. That delayed break-even target signals that the turnaround is proving more complex and, well, time-consuming than they initially hoped.
Right.
It really underscores that despite the real progress they've made, this is still a very challenging task. It's going to require sustained focus over several more years.
Which is probably why CEO Sean Summers extending his tenure to May 2028 is highlighted in the SENS. You need that stability for this kind of multi-year effort.
Exactly. Continuity and leadership is crucial during a deep turnaround like this.
And they did mention recent sales data post-period shows continued growth, although, yeah, pretty modest.
And seeing that positive like-for-like growth continue even post-period end provides some encouragement that the H2 momentum wasn't just a one-off blip.
Okay. Next, African Bank Holdings, ABHL, and African Bank ABL, with their interim results to March 31st, 2025. They talk about green shoots from their accelerate diversification strategy. What stands out there?
What's fascinating is their deliberate pivot. I mean, they're traditionally seen as primarily an unsecured lender, right?
Yeah.
But the SENS highlights these acquisitions, like SASFIN's commercial property finance and capital equipment businesses. These aren't just little add-ons. They feel like fundamental strategic moves to really build out their business and commercial lending book.
And you see it straight away in the numbers. Net advances are up 20% overall, but the business and commercial books soared by 49%. Personal banking advances grew much less, which they explicitly say is intentional.
Exactly. And that intentional shift changes their risk profile. Moving into secured lending areas like commercial property, equipment finance typically means lower credit risk per loan compared to unsecured personal loans.
Makes sense?
And that connects directly to the improvement in their credit metrics. Credit impairment charges are down 10%, and the credit loss ratio fell from 6.6% down to 5.3%. It's pretty clear evidence that diversification is working to de-risk the balance sheet.
They're also growing their customer base, up 6% to 6.1 million. Transactional banking customers and personal banking are up quite a bit, 28%. The SENS also mentions they're engaging with the Prudential Authority about a capitalization transaction, but say their ratio is above minimums.
Growing transactional customers is crucial for any bank's core funding and, cross-selling opportunities. And that note about the PA engagement just indicates they are proactively managing their capital position as the balance sheet expands pretty rapidly because of this growth and diversification strategy.
Okay. Shifting gears slightly, Barloworld BAW interim results to March 31st, 2025. Revenue down 5.8%. They pin some of that on Vostokhnaya Technika, their Russian business.
Right, VT.
And say revenue and EBITDA actually increased when excluding VT.
Yeah, that's pretty standard practice. When a company has a business unit significantly impacted by external events or strategic changes, like the situation with the Russian operations, they'll often present numbers excluding that unit to show the underlying performance of the rest of the group. The SENS is clear here. The XVT performance is positive.
But HEPS was down 20.5%, and the dividend followed, reduced to 120 cents from 210.
Yeah, that drop in HEPS and dividend aligns with the overall reported profit decline, even with that positive XVT performance. suggests other pressures were at play somewhere else in the business.
They also had this interesting voluntary announcement about another extension now to September 2, 2025, for filing a voluntary self-disclosure narrative account to the U.S. Bureau of Industry and Security, BIS. What's that about?
Okay, so the bias thing. The SNS tells us they are still working with the U.S. authorities on this voluntary self-disclosure, and they just need more time. Crucially, the SNS doesn't explain why they are making this disclosure to BIS, which deals with things like export controls and security matters. We just know they're talking to them and need more time. No detail on the what.
Okay, so we know they're talking to BIS and need more time, but not what about. Good to clarify. Exemplar REIT XEE reported audited results to February 28, 2025. Some good growth figures here. Net property income up 10.2%, HPPS up 25.4%.
Yeah, for a real estate investment trust, or REIT, net property income is fundamental. It shows how well their properties are actually generating income after costs. So strong growth there is key.
They increased their total distribution per share by 10.4% to over 153 cents. And the SNS is quite specific here. It's split between a dividend and a return of contributed tax capital. Why is that distinction important for you, the shareholder?
This is a really crucial point, especially for tax purposes, and the SENS detail highlights it well. A dividend from a REIT is generally taxed as income for South African residents, though you might be exempt from dividend withholding tax if you submit the right forms.
Oh.
But return of contributed tax capital, or CTC, that's treated differently. It's seen as a return of your original investment. It reduces your base cost in the shares. It's not taxed as income or a dividend right away.
Right.
But if that return of capital eventually exceeds your base cost, then it could trigger a capital gain event. So knowing that split is vital for your personal tax calculations.
That's a great point. Thanks for clarifying the practical side of that. And finally, in this financial results section, Dischem, DCP, gave a simple positive trading statement for the year ended February 28, 2025.
Yeah, pretty straightforward. The SES notes they expect EPS and HEPS to be up by somewhere between 19% and 21%. A trading statement is essentially a regulatory requirement and, a courtesy to the market.
Right.
If your results are going to differ significantly from the previous period in this case, by more than 20%, you have to issue a statement to give investors a heads up before the full numbers come out. Just manages expectations.
Okay, moving from the big numbers to big moves, corporate actions and strategic positioning. This is where companies announce deals, structure changes, or, significant strategic intentions.
These are often the really forward-looking announcements that can reshape a company's future or its ownership structure.
First up here, RSEI or ARC Investments, AL. The SCNS details a proposal from ARC and its subsidiary to buy out the shares they don't already own, leading to a potential delisting from the JSE and A2X. The offer is ZRR 9.75 per share.
A delisting is a pretty significant event, right?
Oh, it is, especially for minority shareholders. A delisting means the shares will no longer be traded on the main public exchanges like the JSE or A2X. This dramatically impacts liquidity, basically. Your ability to easily buy or sell shares in the market disappears, or it gets much harder. They're also planning to re-domicile the company from Mauritius to South Africa. But the really critical information in this SENS seems to be for shareholders who don't accept the offer and remain shareholders after the delisting. The SENS is quite specific here.
And rightly so, because the situation changes fundamentally for those shareholders. The SENS states that while Straight will continue administration for dematerialized shares, and brokers can technically still facilitate private sales, RRCI itself will not facilitate trading, act as a market maker, or provide any trading facilities post-delisting. That's a really key point.
Yeah, seems crucial.
Remaining shareholders will basically be holding shares in a private, unlisted company, and finding a buyer or a seller for those shares could become very difficult and potentially time-consuming. Liquidity essentially dries up.
So very limited liquidity post-delisting, and the company won't help you trade. Got it. They also mention SA residents need to sort out exchange control compliance before the redomiciliation if they're trading.
Yeah, that's standard regulatory stuff around cross-border movements of assets, but worth noting for anyone affected.
Next, Hyprop Investments, HYP. They own shopping centers in SA and Eastern Europe, and the SENS highlights a strategic priority, finding new growth opportunities in Eastern Europe.
This really sets the stage for their specific announcement, doesn't it? They've publicly stated their intention to expand in that region.
And the potential deal is a voluntary bid to acquire a controlling stake in MAS PLC. To fund it, they're proposing a capital raise by issuing new shares for cash via a book build, and possibly using shares for the bid itself, too. The capital raise is open now.
This directly supports their stated strategy.
Huh.
A voluntary bid is basically an offer to buy shares, but it's not mandatory for shareholders to accept it. And a capital raise by book build is a common way for listed companies to raise significant cash quickly, mainly from institutional investors, where the price is set based on the demand they see. This SENS clearly shows they are actively pursuing and funding this European expansion plan.
Blue Label Telecoms, BLU, had a brief announcement about the availability of a SELSe presentation.
Yeah, this follows their earlier SENS from May 16th about exploring a potential restructure of subsidiaries, including SELSe. While this SENS is short, the availability of a detailed presentation usually means the company is providing more context or background on significant strategic stuff,
Right.
like a potential restructure.
Yeah.
Even if the SENS itself says it's just for information only and not an offer, potential restructures involving SELSe have a long and, well, pretty complex history.
Indeed. And Caxton and CTP Publishers, CAT, simply reported that resolutions at their general meeting were approved relating to an odd lot offer.
Yeah, an odd lot offer is a fairly standard corporate action. Companies sometimes offer to buy back very small numbers of shares, typically holdings less than 100 shares, mainly to simplify their share register and cut down on admin costs.
Makes sense.
It gives those small shareholders an easy way out without having to go through a broker for a tiny trade, usually approved routinely, like this one was.
Okay, let's pivot to something that always sparks curiosity. Director, officer, and insider dealings. This is where we see who inside the company, or close to them, is buying or selling shares or getting incentives.
Yeah, these disclosures are mandated for transparency, right? Shows whether those closest to the company's operations are sort of backing it with their own money or maybe taking some off the table.
KL Group, KAL, reported the acceptance of awards under their long-term incentive plan, LTIP, by multiple executive directors. These were nil-cost options to acquire ordinary shares.
Right, an LTIP. It's designed to align executive interests with shareholder interests over the long term, usually several years. Options, especially nil-cost options like these, are a popular mechanism. They give the executive the right to acquire shares at no cost in the future, usually if certain performance targets are met or after a set vesting period.
So the value comes later.
Exactly. Their value comes entirely from the potential increase in the share price between now and when they can actually exercise those options.
The SENS lists specifics like S. Walsh accepting over 292,000 options with a deemed value of over R11 million. That's not cash they received today, though, is it?
No, absolutely not. That deemed value is just the theoretical value of those options based on the share price at the time they were accepted. The actual value they realize depends entirely on the share price when those options vest and can be exercised potentially years down the line. It's all about potential future value tied to performance.
Got it. Impala Platinum, IMP, saw an executive director and a prescribed officer selling shares.
Yeah, these were reported as on-market disposals, meaning they sold the shares via the stock exchange. Companies require clearance, usually from the board or a designated official, before directors and prescribed officers can trade. This is to prevent any hint of insider trading, particularly around sensitive periods like results announcements.
The SCNS gives the details. M. Kerber sold over 58,000 shares for R$8.19 million, and Kate Shilver sold 20,000 for R$2.84 million. Clearance was obtained for both.
So the SCNS reports the facts of the transaction: who, what, when, how much. Crucially, though, it does not tell us why they sold.
Right.
It could be personal financial planning, buying a house, diversification, any number of personal reasons, totally unrelated to the company's immediate performance outlook. We just know the transaction happened and it was compliant.
Kumba Iron Ore, KIO, had a dealing reported by a major subsidiary, Sishen Iron Ore Company. This was shares forfeited by an employee who left before their shares in the Bonus and Retention Share Plan, or BRP, vested.
Okay, so this is a different scenario. Employee share plans, like BRPs, often have clauses where participants forfeit any unvested shares if they leave the company before a certain date. This wasn't a discretionary investment decision by a director. It was a mandatory sale triggered by the rules of the employee plan when someone's employment ended.
Okay.
It gets disclosed because it involves company securities and a subsidiary, but it's really just plan mechanics driving the sale, not an investment view.
And Spear Rate, C, reported several purchases by associates of Executive Director Quentin Michael Rossi. The SENS names the company where he has roles and his minor children as the associates.
Yeah, JSE regulations require disclosure not just by the directors themselves, but also their associates. That includes immediate family members and related entities like trusts or companies where the director has influence. It's all about ensuring full transparency around potential indirect interests.
The transactions listed involve smaller amounts, like R26K and R10K for the company associate, and roughly R14.6K each for the children, purchased on market in mid-May.
Yes, and the SENS details the nature of interest, noting whether it's beneficial, meaning the associate benefits directly, or non-beneficial indirect, like shares held in trust for minor children, perhaps. These were also on-market purchases where clearance was obtained, just as if the director was trading themselves, even for these smaller amounts.
Okay, let's quickly touch on board changes. Simple updates, but, important for governance.
Absolutely. These announcements keep the market updated on the composition of the company's leadership and oversight.
Superdrive Investments announced a change. Mr. Nicholas Russell Clark resigned, and Mr. Brendan Harms was appointed. The SCNS notes Mr. Harmsy has an extensive background in capital markets and structured finance.
Bringing that specific expertise onto a board, especially for a company like Superdrive, which seems involved with financial instruments, suggests they're maybe reinforcing their capabilities in that particular area.
Thungela Resources, TGA, appointed Mr. Benjamin Kodasang as lead independent director effective May 23rd. He was already an independent non-executive director there.
Yeah, the lead independent director role is pretty significant in corporate governance frameworks. They often act as a key point of communication and oversight, especially liaising between the chair and the other independent directors. Appointing someone already on the board provides continuity.
Finally, let's wrap up with debt instruments, ratings, and other financial updates. This is the sort of nitty-gritty of company financing.
Important details for bondholders or anyone interested in the company's balance sheet health and how it's funded.
Standard Bank, through its SBEN 51 code, announced a new financial instrument listing, Equity Index Linked Notes. What exactly is an equity index linked note?
Okay, so unlike a standard bond that typically pays fixed interest, the return on an equity index-linked note is tied to the performance of an underlying stock market index. So your return depends on how, say, the FTSE Top 40 performs, or whatever the specified index is.
Right.
This specific listing is for ZAR 225 million, but is part of a huge ZAR 150 billion program they have. And the SENS also notes they'll be settled by delivering ETFs, exchange-traded funds, not necessarily cash at maturity.
Standard Bank also had a corporate action on an existing instrument, SBRN 18. There's an interest and capital payment due June 17th.
Right, so this looks like a structured repayment. The SENS says the payment includes 25% of the initial capital. So if you hold this note, you get some of your principal back along with the interest payment.
Okay.
And your base cost in the note reduces accordingly. The SENS says from ZAR 3,750 down to ZAR 2,500 per note after this payment. So for a bondholder, you receive ZAR 1,250 of your principal back, plus ZAR 400 in interest, which they note is a 32% coupon on that payment date. And then you need to adjust your records for that lower base cost going forward.
First Rand Bank, FRB, had multiple interest payment notifications for various bond codes. Payment dates in early June.
Yeah, routine but essential SENS updates for bondholders that just detail the upcoming interest payments. The SENS shows a mix here. Some bonds have fixed rates. Others are linked to CPI, meaning the interest rate adjusts with inflation.
Yeah.
The payment amounts vary significantly depending on the specific bond, from hundreds of thousands up to over R7 million for some.
The Queenie Warehousing Conduit, BITT, also had a quick note about an interest and capital payment for instrument TWC 497 due May 29th.
Similar idea to the Standard Bank one, but for a warehousing conduit. These structures often issue debt that's backed by specific assets or cash flows. This SENS just confirms a scheduled payment is coming up, including a pretty substantial capital repayment element over our 337-meter capital, it says.
Okay. In credit ratings, Eskom Holdings reported Fitch Ratings affirmed their rating. Long-term local currency IDR at B with a stable outlook. Linked, the SENS says, to the strong link with the SA government rating.
Yeah, that link is absolutely key. Eskom's main credit rating is heavily influenced by the government's rating because analysts perceive a high likelihood the government would step in and support Eskom if needed. So their rating is somewhat capped or constrained by South Africa's sovereign rating.
But the SENS also highlights a positive. Fitch revised Eskom's standalone credit profile SCP up to CCC plus from CCC. What's the difference between the main IDR and the SCP, and why is the SCP revision positive here?
That's a great question. So the SCP is Fitch's assessment of Eskom's creditworthiness on its own, kind of without assuming that government support kicks in. So an upward revision of the SCP indicates that Fitch analysts see improvements in Eskom's intrinsic operational and financial strength. The SENS specifically attributes this SEP revision to Fitch's view of improvement in operational performance and a likely material increase in EBITDA in FY25, FY29.
Right.
It's a positive signal that the fundamental business trend, the underlying operations, are seen as improving, even if the overall rating is still held back or constrained by the sovereign rating.
So the core business is looking better, operationally at least, but the government link keeps the main rating relatively low.
Got it.
The Development Bank of Southern Africa, DBSA, amended their policy on politically exposed persons PPPs. It's now the PEPs and Prominent Influential Persons PIPs policy.
This looks like a fairly standard compliance update. The SENS explicitly links it to Schedule 3 of FICA, the Financial Intelligence Center Act. FICA requires financial institutions to manage risks associated with individuals holding prominent public positions, PEPs, or those who exert significant influence, PIPs. This is just the DBSA bringing their internal policy in line with the latest regulatory definitions and requirements, standard practice for financial institutions.
And finally, the 10X Wealth Top 20 Capped ETF had a simple announcement: delisting from the JSE main board effective May 28th.
Yeah, a delisting means it just won't trade on that specific exchange anymore. The SENS notes the securities remain an issue, which means shareholders still own their portion of the underlying investments. But if you hold it, you'll need to figure out where it might be listed next, if anywhere, or how you might trade it off market if you want to sell. Sometimes ETFs delist if they're merging with another fund or perhaps changing exchanges.
Okay, so bringing it all together then, looking at this stack from May 26, 2025, we've seen companies like Altron and Pick n Pay reporting results showing real, albeit sometimes complex, progress in their turnarounds.
Definitely progress, but challenges remain for PMP especially.
Yeah. We saw strategic plays like African Bank's clear diversification push and Hyprop actively pursuing European growth. We covered the routine but important corporate actions, financial instrument updates, and got that glimpse into director and insider dealings.
You've effectively just had a curated briefing on some of the most significant news hitting the JSE today. It helps you, hopefully, quickly grasp the performance trends, the strategic directions, and some of those behind-the-scenes activities that are shaping these listed companies right now.
Absolutely. Each SENS is a snapshot, isn't it? But when you look across them, you start piecing together bigger pictures about sectors and maybe the overall market mood.
That synthesis is key, trying to see the patterns.
So here's something to consider. Building on that director dealing section we covered, we saw multiple updates today about directors, prescribed officers, and their associates buying shares, selling shares, or accepting long-term incentives like those nil-cost options. How much does that specific activity, even the smaller transactions by associates or the acceptance of potential future value, how much does that really tell you about the actual sentiment inside a company compared to the big financial numbers and strategic announcements they put out?
Good question.
Is it just noise, or is it a crucial signal, something to mull over until our next deep dive?